Today, the fiction continues. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Well, as you probably know by now, the US markets went to new highs overnight, reacting, of course, to the fact that Biden is now getting funding to manage transition, and also that the virus vaccination news continues to improve. But you have to ask whether the markets are simply too stretched, too far from reality, and whether, in fact, it's about to collapse. Now, of course, the collapse of the markets have been forecast for quite some time, and indeed, some of those forecasting such a crash have appeared on this channel. So it's worth just thinking about what may be going on here. And there are a few different factors that are worth reflecting on. The first is, of course, that we've got a lot of new investors coming into the market at this stage. And in fact, a lot of the smart money has been sitting on the sidelines for some time, waiting for the correction that has not yet come. And of course, we also know that if you calculate share prices based on prospective future earnings, then the share prices are just way, way too high. And of course, once again, we also know that all the central banks around the world have been driving interest rates lower, pumping liquidity into the system, and a lot of that liquidity is going straight back into the financial markets. And that's probably one of the reasons why things are looking the way they are. But again, you've got to ask, is it feasible that this can continue? So there was a very interesting article published today by Damien Klassen from Nucleus Wealth. And as you may recall, Nucleus Wealth and I have created the Walk the World Fund and Walk the World Super, because I do think that they've got their finger on the pulse when it comes to what's going on in the markets. Now, Damien's article starts with the simple question of whether capitalism is finished, and has the debt cycle been suspended? And he looks at some charts by Ray Dalio, which talks about the debt cycles, and in particular the contrast between a short-term debt cycle and a long-term debt cycle. With record levels of corporate debt around most of the globe, and the COVID-19 lockdown suggests that this would be the end of the current short-term debt cycle and potentially the end of the current long-term debt cycle. But governments and central banks have come to the rescue. And such swift intervention by central banks and governments hit pause on the start of the deleveraging. In effect, they threw a lot of money at the economy, and most ended up cushioning the blow for people who suffered from the shutdown. But a significant amount also ended up with people who didn't suffer. Also, without travel, many more affluent people travelled less and consequently increased their savings and investments. And evictions and bankruptcies were made more difficult, and interest rate holidays on loans were handed out freely. The new rules prevented negative outcomes while encouraging positive ones, and the stock market boomed. So, is capitalism finished? Now, Nucleus Wealth has been cautious on risk for months, and avoiding the crisis at the start, but with minimal participation in the market recovery. And to date, they've been wrong. They did identify the most likely reason to be wrong would be if governments were to take even more extreme steps to cancel capitalism, and that is precisely what has happened. In many countries, extend and pretend has replaced the threat of bankruptcy. Someone who can't pay their rent is not evicted, but allowed to accrue debt. Don't foreclose on those who can't pay their interest. Instead, build up their interest payments into a larger debt burden. And he says the end game seems to be a cohort of zombie consumers and businesses, weighed down by debt burdens too massive to ever pay off, but supported by interest rates low enough to keep them from defaulting. And US Treasury Secretary Mnuchin is letting several minor lending programs expire at the end of the year, to the loud complaints of many, including the US Central Bank. Many programs will likely be reinstated once Biden is in power, and in other countries there is very little consideration given to finishing similar programs. So it would seem that we are up for a zombie future. And then, of course, there's a critical question: can the debt cycle blast higher yet again? The question from here is whether a new debt boom can be launched without the old one ever having peaked. And Damien says, until recently he thought the odds favoured the end of the cycle, and he was wrong. And he's still sceptical of a debt boom for businesses. Governments and central banks will try, but debt levels are already high, and further interest rate reductions will be very limited. But another household debt boom is actually possible, although of course Australia has already played this card several times before. Look at the household debt to GDP ratios. The other difficulty is that despite the European Central Bank's best efforts, household debt has been declining across much of the Eurozone. And actually deleveraging is happening even in Australia if you look below the covers. The most likely outcome now appears to be continued increases in government debt, but limited increases in corporate debt, and household debt is an open question. So the question then becomes, are we reduced to simply watching governments and central banks? Mostly it seems that's right. It seems clear that policymakers have decided on zombification: limit bankruptcies, increase debt, never raise interest rates again. Now that doesn't make for a healthy economy, but it limits short-term pain, which appears to be the current goal of every politician. So the economic plan is to try to get a debt-funded consumer boom going so that bankruptcy protection and consumer support can be removed down the track. And of course that means that policy mistakes are what matters from here. And the goal seems to be to prevent a business cycle from occurring. And there are indications that if a normal business cycle starts to occur, it will be a sign to sell. But with so much support, it's likely that markets will continue to grind higher for some time. And that takes us, of course, into even more stratospheric levels, where values have no real link to the underlying. So with that as context, let's just have a quick look at some of the market indices, firstly in Australia and then around the world. And we're going to start with the ASX 200, which closed today at 6,683, still below its peak of over 7,000 earlier in the year. The 200 financials in Australia has recovered quite a lot. It's now at 5,659, but again still remains below the peak earlier in the year when it hit close to 6,495. Now, real estate trusts are doing quite a bit better. Again, they fell dramatically when everything else fell, but they're still well off their highs. They're around 1,470 now, compared with 1,717 previously. And the local volatility index has dropped considerably, sitting at 1394. Remember that it reached a staggering 44 earlier in the year. And the S&P ASX 200 futures is pointing for more rises ahead at 6,686. Now, the major banks have recovered a lot of the ground at 2366 for ANZ, still below the 28 previously. A CBA is at 82.37 and is still below the 90.69 that it reached previously. NAB is at 24.05 and Westpac is at 20.89, well below its previous peaks. Now the regional banks are also following a similar shape, with the Bank of Queensland and Bendigo and Suncorp moving up to various degrees, although still below previous peaks. Now Macquarie, of course, is doing quite well. It's at 141, and one of the mistakes that I made was selling out earlier on because I felt that Macquarie would be impacted much more by the international situation. It's still a little bit below the 151 mark, and you wonder whether it can make it much higher than that. Well, maybe it can, despite the fact that projected forward views are now hard to come by, as very few companies are actually giving forward expectations at the moment. But of course, AMP has hardly moved at all at 173 because, of course, there's so much going on there. Genworth is quite interesting, the mortgage insurance company. That's at 258 now, still well off its highs of more than 385 previously. And you wonder to what extent those prices are to do with higher expected mortgage defaults ahead. I think we will see mortgage defaults, but not in the very short term. And, of course, the Aussie dollar is at 73.39 at the moment. It's really recovered significantly from where it was previously. Remember that it got to 58 cents at the peak of the fall. And the Reserve Bank will not be happy with the dollar sitting at 73. That is not where they want it. They want it closer to 60. And so far as the rates are concerned, the 2-year rate is at 0.1. Well, that's precisely where the Reserve Bank wanted it. And the 10-year rate's a bit more volatile, but it's still at 0.932, so signalling very low rates for a long, long time. And of course, the gold Aussie cross is down at 2462. Remember that it hit a peak of 2836 earlier in the year. And just for completeness, Bitcoin, of course, continues to climb away. In Aussie dollar terms, it's 25,926, which is a very significant lift. The question, of course, as we discussed recently with Caroline Bowler, is whether this is something strategic or something very tactical. And just going back to the Dow Jones Industrial Average, at 30,000, of course, Trump came out today and celebrated the fact that it reached that new high. I suspect it was more to do with Biden than anything else. The S&P 100 was also higher at 1,662, all-time record. And the S&P 500 was also up at 3,635. Now, the financials index in the US is at 475.46, and that is still below its previous peak of 515. But some of the banks are doing quite well, like Goldman Sachs, for example, at 237.50, getting close to recent highs again. And the volatility index in the US is down to 2164, well off its peak of 65.88 earlier in the year. Now, some of the tech stocks are still holding up pretty well, like Alphabet, that's Google's parent, at 1,763. Amazon's come back a bit to 3,118, and Apple back a bit to 115.17. And I've read a couple of suggested sells on the tech sector at the moment on the principle that other sectors, those hardest hit by the virus, should come back. For example, tourism, airlines. So we may see some rotation from some of the tech stocks. But again, of course, the tech stocks are a very large part of the market. And Facebook was at 276.92, so back a bit. Boeing's moved up to 218.49. Of course, that's partly to do with their airline now being recertified and the prospect of more airline sales, but sometime later. Now the 30-year Treasury is at 1.599, which is up, well, quite a bit really from its lows. It got as low as 1.19. The 10-year is at 0.875, and you can see the recent rises there from its low of 0.515, and the 3-month is still pretty much on a straight line trajectory. Now the US dollar index is at 92.12, and you can see that it's come way back. Earlier in the year it was at 102.65. And of course Bitcoin continues to storm ahead at 19,036, and you can see that it's close to its all-time high of just over 19,000. And the S&P 500 is also signalling more rises at 3,638. And finally, the Nasdaq futures is at 12,121 at the moment. Again, very high and reflecting the power of the tech sector, particularly in the US. And this really does highlight the problem that we've got a very artificial environment here with all the stimulus measures that we've discussed earlier, all of that liquidity sloshing around the system, probably less lending rather than more lending is what I'm seeing at the moment, particularly in some segments of the market, and of course the housing sector being talked up here and around the world, although actually in some parts of the world people are repaying more loans than borrowing, and even here in Australia there are a lot of people still deleveraging. So we are in a fiction-filled world at the moment. And whilst I don't think it's going to shake out anytime soon, it's looking more and more precarious. And so the question is, do you sit and wait, or do you try and engage in the market? Well, my own strategy has been patience, just sitting and waiting to see how this all shakes out on the principle that this edifice is going to collapse at some point. It's just we don't know when. But if you want to engage more directly in the market, then there are options. And in fact, my tie-up with Nucleus Wealth is one way of accessing those particular opportunities. And finally tonight, I just want to round off a quick conversation that I've been meaning to have for some time, to try and explain what I've been doing and why I've been doing it. There have been 5 questions that I have been receiving over the last few months from the community, and I've tried to address each one as best I can. The first question was, how do I get more detailed information about specific postcodes? And I established the DFA one-to-one service a few months ago. It's been very popular. We've had many conversations. And you can still access that if you want. So that's the first thing that we established. The second question that I was asked consistently was, with the risks of deposit bail-in and with low interest rates on deposits, are there relatively risk-free ways to get market exposure? And that is precisely why I did the tie-up with Nucleus Wealth. It's not without its risks. Of course, markets do go down as well as up. But as we discussed with Damien Klassen and the team last week, Nucleus is positioned with a view to protection as well as growth. And if you go through to the Walk the World Fund and Walk the World Super, you can get a lot more information there and see how that works. And the third question from first-time buyers in particular is, what should they do? Well, I've tried to answer those questions with a couple of shows recently, last night with Veronica Morgan and Megan, where we went through a whole bunch of issues relating to first-time buyers. And there was an earlier post as well where I got information from CanStar on that same subject. So there you go, I've tried to help there. The fourth question I was asked quite consistently was, what do I think about the digital, the bitcoins and those sorts of things? Well, I've tried to make a few shows on those. And I'm arguing that now we're at the point where Bitcoin is becoming more mainstream, but of course it's still with significant risk. And the fifth question is, what about mortgage stress? What about future home price trajectory? Well, we'll be running our next show on Tuesday, where we update our scenarios to the end of November. And I can tell you that there will be some very significant movements based on where we currently are relative to where we were last month. So we're trying to answer the major groups of questions that we're getting. Now, if you've got other questions or other issues you'd like me to explore, feel free to leave a message or contact me via the DFA blog. Always happy to take feedback and suggestions. I'm trying to make the Walk the World channel as flexible and agile as I can. And finally tonight, I just want to play you with this. This is my latest iteration of a new intro, which isn't quite finished yet, but I'm interested to know what you think. Does this work for you compared to the ones that I'm currently using? Let me know in the comments below. And that's it for tonight. Thanks for watching, and I'll see you again next time. This is Martin North from Digital Finance Analytics, signing off.